Good afternoon, everyone, and welcome to Farm Credit Illinois' Ag Minded Hour webinar series. The intent of this series is to offer timely topics and information that are easily digestible over the noon hour while you take lunch or go about your day. Before we dive into today's topic, let me take a moment to introduce our presenters this hour. With us today, we have three guests from Kirby Wealth Management. Brian Bowman is the Director of Retirement Plans and has been solving small business retirement plan needs for 23 years. He is married to his beautiful wife, Diane, and has successfully gotten two kids off of his payroll. Carrie Eiseminger has been with Northwestern Mutual since 2012 and recently joined Kirby Wealth Management Group. With her agriculture-focused financial planning designation, she is elevating the planning experience for all of their ag clients. Carrie is the co-founder of a women's networking event locally here in Champaign, Illinois, and an advocate for women in business. She and her husband Chad have three active boys, and when she's not working, you can often find her on the sports field cheering on her boys. Ian Park is a certified financial planner and partner of the Kirby Wealth Management Group. He has been working for small business owners and farmers since 2013, with his own practice before joining Kirby Wealth Management. We are certain you will all take some great information away from these three today.
All right, well, I'll start us off real quick. So good afternoon, everybody, and thank you again for joining us today for what we hope you feel will be a valuable use of your time. So as Caitlin mentioned, my name is Brian Bowman. I'm the Director of Retirement Plans for Kirby Wealth Management Group, and we are based in Champaign, and we're part of Northwestern Mutual. So just a quick kind of elaboration on the bios. I've been working in the retirement plan industry for almost 25 years, and my focus is primarily with closely held businesses and farm operations. I grew up in the country outside of Philo, and full disclosure, my parents are not farmers, but I always considered myself one because all my buddies were. So I think that's part of the reason why I like working with people in the ag fields. So, but the next two are the ones you really want to, that you're really here for. So I'm joined today by two other members of our team, Ian Park and Carrie Eiseminger. You heard a little bit about them already, but Ian's been in the industry for over a decade. He's our Director of Planning and a CFP for our team. Ian does personal planning, but is also a tremendous resource when it comes to business and estate planning as well. Carrie's a wealth management advisor and has been in the financial industry for almost 13 years. She also focuses on personal planning as well as business planning and does a great job. So the title of the presentation is Tax Minimization and Employee Retention Strategies for Farm Families, and we're going to cover a lot of ground in a short period of time. So I'm going to turn it over to Carrie and let her get this presentation started, but thank you again for coming.
All right, thanks, Brian. Yeah, as Brian said, we are going to talk through tax minimization and employee retention strategies for farm families. So let's jump in. Please send questions as they come up. We will answer those as we go through the content today. But we're really going to kind of give some basic information to get started and then go through some scenarios that might relate to your farming operations. So as it relates to our conversation today, the problem that we're trying to solve is tax. The standard industry tax strategy for you right now is to prepay inputs, use Section 179 and bonus depreciation to lower your taxes. We're always focused on trying to get into the lowest tax bracket and pay as little tax as possible. And that strategy really does work well, especially equipment, land purchases, things of that nature. It works well until you get ready to sell your equipment and you don't have those offsetting deductions to kind of manage the sales. So what we find is without a financial planning strategy, you can wake up in your highest earning years in the highest tax bracket and see a really, really big tax problem. Oops, I think I went one too many slides. Let's see. Okay. Ian's going to jump in and he's going to kind of walk through how we are leveraging retirement plan strategies to manage that tax problem. So Ian, I'm going to jump you onto this slide to get started.
Okay. Yeah, so what the slide helps us visualize is how tax brackets change in those years with higher incomes. And so again, kind of illustrating this idea that as I'm exiting the farm operation, I don't have the input costs anymore, so I don't have those deductions. And let's say, we will illustrate this with a couple of examples here in a minute. But if there's recapture on the equipment and then all the grain is being sold, we could have these years where we, have $1 million of income and we take those dollars and tax them at the highest rate, when in previous years we were deferring and deferring and deferring, prepaying and making our income as low as possible. And then as soon as you retire from the operation, then your income now is much lower. And so a lot of what we're going to be talking about revolves around taking these couple of years where income is taxed at the highest rates and getting those dollars taxed in the future at lower rates. And so an optimal tax plan is one where your income is smoothly distributed, and that way good years can be pushed off to future years, and then you don't ever have any of your income taxed at the highest brackets. You can tax all of your income at the lowest brackets. And so a lot of what we're going to be talking about revolves around kind of that central idea. And so, so the first thing that is important to understand in executing on that idea is just that we want to optimize how much tax we pay by minimizing not just our annual tax liabilities, but we want to minimize our lifetime tax liabilities. So yeah, maybe by lowering our income today, we could be increasing our income in the future. And so we, may push ourselves into a bracket that we don't want to be in. So the first part of the plan, the first part of the solution is just having a integrated strategy where we decide, okay, projecting out the next 10, 15 years even, what do we want our income to be each year? Do we want a higher income this year since, let's say the next couple of years taxes, the bottom two tax brackets are going to be at lower rates than, they will in 2026. So instead of at 15 and 18%, we could tax it at 10 and 12. And so that's also true going forward. So the second step, in addition to kind of doing the projections out into the future, where we, figure out where we can minimize tax by which year we put the income in. The second thing that we will use is specialty retirement plans to help take some of that income off without having to buy more equipment than, let's say you don't need to buy more equipment as you're, especially for those of you that may be exiting the farm operation. So if we were to say there was one idea that we wanted everyone to take away from a product standpoint, it would be the specialty retirement plan that now is kind of colloquially referred to as a cash balance plan. So you'll also see this in our presentation. Sometimes it will be called a defined benefit plan. And again, now we're getting into kind of technical lingo, but like a 401k or these plans where you decide I put in this amount, those are defined contribution plans. These specialty plans where you can do much larger contributions are called defined benefit plans. But if you're going to walk away from this and go, talk to your buddy, hey, have you heard about, this idea? I would just call them cash balance plans. I think that's kind of what the industry is settling in on as a much less technical way to refer to them. So if, I'm otherwise going to have an income of $750,000 and I, want to put in $300,000 or $400,000 into this retirement plan, so then in a couple of years when I'm retired, I can pull the money out at that time. The third part of the plan would then come into play. We would say, okay, let's plan on putting about this much money in, so that way when you're in retirement and you don't have big Schedule F incomes, we can pull the money out and tax it at a lower number.
Yeah, I would add these plans have been around for quite a while, but they are gaining a lot of popularity right now, especially in this industry, because of the tax management strategy, where it gives us another way to defer and allows us the opportunity to be able to spread tax over all of the retirement years as you're taking the distributions out of the plan. So it's a really good way to kind of layer in another tax deferral strategy. So what we're going to do is we're going to kind of talk through the plan as it relates to different farming scenarios. So one of the things that we want to mention is every single farming family that we work with is different. That there are different dynamics and different complexities that we always say kind of wrinkle or change how we would strategize. So today we are using a 60-year-old farmer who is really trying to transition out of the operation main role within the next 5 years. We've got over 1 million of crop that we can store, we can sell. And what we're going to do is we're going to kind of take this scenario through a bunch of different circumstances that we've seen working with our clients to show you how we're integrating these retirement plans into their financial strategy.
Okay, and just to double down on the disclosures, we do have to say that these examples are realistic, but they're never going to be precisely accurate just because of the personal data that Carrie was mentioning. So in this schedule, or in this slide, if you look at this kind of flow chart here at the bottom, we'll say that at 2024, this would kind of be our rough plan, where we'll finish the year with a Schedule F income of about $150,000. And this is worth mentioning just because you have to have Schedule F income for these retirement plan contributions. So especially as it relates to the terminal farmer, the person who's getting out and maybe recapturing the depreciation on their equipment, like those equipment sales cannot be used for retirement plan contributions. We can still lower your income that you have from those sources, but if the only income, on the books was from, depreciation recapture, then you're not going to be able to make a retirement contribution like you would if you had other income on the Schedule F. So let's say that at the end of the year, that income is $150,000. Then at 60 years old, making some other assumptions, you could put into the cash balance plan. Here it's listed as a DB contribution or defined benefit. So we'll just call it the cash balance plan. You could put in $275,000. So $275,000 goes in, and that's a deduction, just like it would be when you buy fertilizer. So it's a deduction that you put in, and then the money goes into the retirement plan. Eventually that money will turn into an IRA. You can move it over and pull money out in the future once you close the plan. So in addition to that, or sometimes, depending on how big the enterprise is, we will also have a 401k plan. And the 401k plan, you could have the 401k plan as its own entity without the much bigger contributions if you didn't have a need to put in so much. But the 401k can be a combination, or it can stand alone. So that would be another $76,500 as the maximum. And then if you were in the, I think that's the 32% tax rate federally with the 5% Illinois, then you're saving yourself $100,000 from those contributions each year that you make that contribution. And if you did that same contribution number for 5 years, then this 60-year-old farmer, that they're going to have at 65, something like $1.5 million that they put into the plan. Okay, and I will just again make another caveat that once these plans get going, there is flexibility on how much is contributed each year. So just this last week, we were working on a plan for one of our clients, and they had a much lower income last year. So we're kind of deciding what they're going to put in for the previous year. They only wanted to put in the minimum amount. It was, something like 15,000, something very small. And next year, the maximum amount that they could put in was $1 million. So, that's a operation with 2 of the first generation and then 2 of the next generation. So that range is, that's probably as big of a range as we've seen, from 15,000 one year to the ability to put in $1 million. So there can be some flexibility in the design on where we get here. But this example would basically allow you to take, something like 450,000 of income and push that off into the future, where we think, future tax rates are going to be lower than if we had all this income recognized this year. You'll pay a much higher rate if we don't do that. So we push it off. And so this is going to be, as Carrie said, we'll develop this, but that kind of serves as a baseline.
Yeah, and one of the other things to think about when we're talking about this type of strategy is we can't just do it the year that you're ready to be done farming. The cash balance plan needs 3 years. Ideally, we have 5. So somewhere in that range, we've got to have time on our side to make this type of strategy work. So the earlier the conversation starts and the quicker we start strategizing on how are we going to manage that tax and build up the plan, the more successful we are helping clients with this. Okay, so we're going to take this scenario and we are going to get onto a family farm, right? Most of the clients that we work with, we've got multi-generations sitting at the table having the conversation with us. So we have the same 60-year-old farmer. We've now got 3 owners, though. We've got parents in their 60s. We've got the 2 children in their 30s who are gradually going to be taking over the operations. And then we've got 1 employee who's not related that we've layered into this example.
So again, this is back to the contributions that are allowable, and which again may not be what you want to do. But if we assume that the income for the oldest generation is something around 200,000, then we'd be looking at a potential contribution of, let's say, anywhere from 100 to 375,000 that could go in. And so again, another income, another set of facts, another range. And then for the children, the second generation, those contributions, let's say for this example that they're going to put in 15 to 30,000 for each of the second generation, for each child. And so, their employees, they're working, they're getting their contribution there. Of course, it could be much bigger for the kids, but for the sake of our example, we're saying that, we're favoring the first generation owner. And then a good opportunity for us to take a comment on the non-family employees. With these plans, there is the ability to exclude some employees, depending on how big the operation is. But with a situation like this, where you've got 1 additional employee not related, you're going to have to cover that person. And with a cash balance plan, you have to assume that you're going to be contributing something. Let's say it's $3,000. So hopefully this is a good thing, especially when we get into like employee retention. This is an additional $3,000 of compensation basically that's going to be paid out to them. And hopefully that, helps you retain that employee. We do, of course, very regularly come across situations where people say, I don't want to put money in for anyone else. I'm trying to do tax planning for myself. I'm trying to, play this bracket game, with my own money. I'll work on my estate planning or my gifting strategies to the kids or whatever it is, as a separate line item. I don't want to give any money to anyone else that I don't have to, right? I want to minimize what I pay to the other employees. So those conversations we'll have, of course, and it can be designed where it does minimize what's paid out to those other people, but you should just kind of put in your minds that it's very likely to do the full maximum contributions allowable, you're going to have to put something in for the employees, right? That's especially true if we go with the 401k plan and the cash balance plan combination. It's usually going to be true for the cash balance as well. And then again, if those maximum contributions were done, let's say, 375, 30, and 3,000, then again, you're taking off 171,000 of tax that you're going to owe from your tax return. And so could be smaller, but that's assuming the top rate, I think, 37 and 5 per Illinois. So the tax savings potential on these plans is pretty significant.
Ian, you touched on it a little bit, but will you dive just a little bit deeper on the idea of trying to maximize the parent's contribution? Kind of what is the expected amount? Like, if we're not trying to add for children, we're not trying to add for the employees, what is kind of what we have to do to be able to maximize tax planning for the oldest generation?
Yeah, so I think that for those participants, you're going to be looking, I think that 3,000 number may be a good guide if we're just trying to maximize those numbers. There are two factors that are going to be very influential in determining the minimum contributions you have to make to, let's say the younger participants. And the two factors are how much money they're getting paid in their W-2 compensation, and then how much or how old those participants are. So in general, there's formulas that are created that determine how much is paid in for each person. And so you just design the formula to favor the older participants, and you favor the higher compensated participants, which should be the older owners. And then that minimizes the contributions towards the younger participants, or potentially even the younger owners also.
Okay, perfect. Thanks. All right, we're going to go one step further because we see this all the time. So again, we spend a lot of our time talking to multi-generation families, helping them think through how are we transferring wealth from one generation to the next. And one of the most common things we see is what do I do for my non-farming children? So if we decide that we want to take advantage of wealth transfer early, for the farming children, we can use some of this cash balance planning as a way to transfer some wealth from the farm earlier in life. We can't do that with a child who is not affiliated to the farm. So we do a lot of strategy around kind of helping parents think through, I want the legacy, I want the wealth transfer to be equal, but I've got one child who is not participating in the farm. How do I kind of make this equal? So we're going to talk a little bit about strategies around that equalization.
Yeah, so, and I may have kind of glossed over this on the previous slide, but we believe that anytime one of these areas of financial planning are being done, whether that's, tax minimization, whether it's investment planning, we would put insurance planning in here. We would also put estate planning, maybe the hottest topic for at least this sample scenario. For this hypothetical farmer, that would be a hot topic for him most likely. We really believe that the client gets the best advice and they get the best service when someone is integrating all of those areas for them. And that's something that we really take pride in, that, we're not going to be the executor on every single area. We're not going to file the trust documents. We're not going to file the tax return. But we will make sure that there's no gaps or inefficiencies by making sure that every part of the plan is communicating with the other part of the plan. And so this is a great example of that, where, if the parents own the business and any money that's not paid into the retirement accounts is income recognized on the parent's tax return, and then as money in the parent's bank account, then that decision to make contributions towards, in this case, the two employee or and maybe even minority owner children is going to have estate tax consequences. So we'll have clients ask us, well, just like Carrie said, what about this, my other child who, let's say he's a teacher that lives in Florida or something. He's not an employee of the farm, obviously. So if we're giving all of this extra money that would have come to us, and now we're funneling, an extra 30, even if it's 30,000 each year to, two of the kids, not the third, how do we make things right? And so, again, if that is the estate plan, for equalization as much as possible, or, whatever version of fair is, because it's not always equal, but whatever the estate plan is, then we say, okay, well, in that example, let's create a, tax-free vehicle for the third child. And, we can design a vehicle where we can dump in the gift tax limit each year. And in this case, conveniently, the 30,000 in our other example, it works here too. Imagine that. So, we can drop 30,000 each year that the contributions are being made, and then we can just equalize it with a gift. And then the other child that's unrelated is getting the benefits. Taxes are still being minimized, and we're helping with the estate tax problem, right? And strategies like this may not be the difference in Illinois' estate tax, especially if it, stays at the 4 million. But strategies like this over a 20-year period of time could be a significant difference, especially if we set them up in a tax-free way. You're not increasing the estate of, your children either, right? They can do things to shift things around for themselves as well. And you're also not increasing the value of your estate by taking that money, and you're not using up your annual, or you're not using up your lifetime exemption, which again, we think is going to get cut in half in a couple of years here. So that would be a perfect example of how we do that. We would say, okay, let's create kind of a tax efficient vehicle. That money can be invested for them. I don't know, maybe that money keeps up with, the appreciation of the ground that, you helped your other children purchase. Maybe it doesn't, right? But you're at least, as far as on the input side, you're keeping things equal with what's given. And so we will help people integrate those strategies into their overall, tax and business plan and estate plan as well.
All right, perfect. So that really walks us through our 60-year-old farmer, the different ways that we're kind of seeing these retirement strategies help us manage tax, help us push that tax over a series of years versus realizing one large tax year. Another big topic that we hear all the time, really across industries, is key employee retention. Are there tools, are there strategies that we can be leveraging that will help retain the employees, the people that I can't afford to lose?
And with this topic, obviously, we've been discussing the retirement plans, or what we'll call qualified plans. You'll sometimes hear that language. Anything that you design where you're then required to put in money to each participant, either as kind of a profit sharing contribution or as a match, those, 401ks or SEP IRAs or simple IRAs, these things should help with employee retention. And the general rule with those retirement plans is that if you do it for somebody, you're going to have to do it for everybody. And maybe you can say, okay, well, you have to be working here for 1 year before you get in. And then after you are here for 1 year, you don't invest the money that I put in there for you. You don't invest with that money right away. There are some restrictions you can do there. But what we've also really found, this is not just with the ag world itself, but across many different industries, is we've seen the growth of non-retirement plans or non-qualified plans. And when the labor market was a lot more favorable for employees here recently, I think that was another kind of bump up and where these became more popular. But we had employers coming to us more frequently saying, man, I've got that key person, like Carrie said, that I don't want to lose. So can I give them something without necessarily giving it to everybody that's on my payroll? And the answer is yes. And it's actually a lot more flexible than what people may think. And that does make it a little bit more challenging for us to give like a perfect scenario that's going to fit your business. I mean, we can't even see your faces here, so we truly don't know the range of operations that could be on the call. But regardless of what it is, there's kind of multiple steps to the process, and these are great. They're hard to explain for the same reason that they're great, is that there's a lot of flexibility and it can be done a range of ways. So the first step you would want to take is answering that question, like, if I provide extra compensation, am I more likely to keep that person, right? Because if that's not the case, then this is not going to help, right? Some people, if they're going to leave it, if they leave because, their spouse wants to live closer to their family in California or something, that doesn't matter what kind of compensation you're providing, they're going to move. But you certainly wouldn't want to be in a situation where they take another job in the same industry because they were getting a few $1,000s more somewhere else. And so that's the first step, is, am I going to keep them by providing extra compensation? And then you think through, how much would that be? So just as an example, let's just say that you're going to give them an extra 5 or 10 grand. So you're going to put in each year 5 to 10,000 into a tax favored vehicle, and we'll just call that vehicle an investment account. So you're going to give the money to them in that investment account, and then they can choose how they want to invest it. So that's not your responsibility. However, you still own the money until they vest. So the second step, the first step is, am I going to keep them? Okay, how much do I want to give them? You could make it a percentage of salary. You could make it, you could make it dependent on how profitable the enterprise is, or you can make it happen for any reason. But you've decided how much you're going to give them and how it's structured. Okay, now you get to decide how long they have to work before they can take the money if they leave. So you can go all the way up to 10 years of vesting. So you could say, okay, here's the money. It's in your account. You can see it. You can invest it. But if you leave in 6 years or even 7 years, that money comes back to me. So this is why we call it in the slide, they can be golden handcuff plans, is because you're really putting some glue in the seat. You're making it very difficult for them to leave. If oh man, if I leave, he put 10 grand a year into this account for me, or 5 grand a year into this account for me, so over the last 6 years, that was 60,000. That's grown to 80,000. If I leave, I'm giving up that 80,000, right? Or you could do it less severe. You could say, I'm going to put in my 5,000 each year, and then when I put the money in, you can take the money out after a 3-year period. So if you're doing 5,000 every single year, and they have to wait 3 years before they can take the money out of the account and put it in their bank, then at any point, if they were to leave, they would be giving up 15 grand, because it would be the contributions for the last 3 years that they wouldn't quite have vested in yet. So that would be another, I would say, probably less commonly discussed, less common knowledge ways that you could look to retain your key people in addition to, or just totally independent of, doing a 401k or a cash balance plan like we were discussing earlier. And in general, these plans, we're going to have to work together to design something that works. The rules are way more of an open field. And then, of course, you've got this ability to make it tax favorable, make it, make it advantageous for them, but make them earn it in, most people do choose time where, I have to be a period of years before it vests. So that's kind of our outside the box thinking or less commonly known key employee retention strategy in addition to the normal benefits or retirement plans.
Yeah, we see this one a lot, especially when there's a timeline where you really need that employee to be with you. So there's a period of time that it is critical that they stay part of the team. We can structure it around that timeline. The other big piece that we try, if there's, I guess, my one takeaway from the call today that I would give the listeners would be, I love the saying, it's never too early and it's never too late to start planning. So a lot of young farmers that we meet with, their focus right now is buying land, it's buying equipment. You will not meet one of us on this call who's going to tell you not to do those things, but what we see is if this is relevant to you, if you're hearing your parents in the conversation we're having today, in 20 to 30 years, this is going to be your problem to solve. And when we talk investments, when we talk retirement strategy, when we have time on our side, we can always be more strategic. So I'm going to let Ian kind of talk through a little bit about some of the advantages to starting early.
Yeah, I think that what Carrie said there summarizes it. I would just add from a mathematical standpoint, if we're trying to avoid this situation where income is being taxed at a higher rate because it's concentrated in a shorter number of years, the ability to plan ahead and, intentionally, hey, let's, we can, of course, there's other considerations, beyond the scope of retirement plans that will be relevant in deciding, how much of your grain, you sell. Even the cost of storage and things like that are going to vary for each business. But let's say that, we're having this conversation purely just from a tax standpoint. We might say, hey, no, you can go ahead and sell more of the crop this year. You don't have to wait until January. And then you'll intentionally be giving your income a little bit of a higher number this year, just so that we can take it right back off of the tax return by doing, a retirement contribution. Or when we see people with lower incomes, then we know we would want to do the same type of retirement plans. We would just want to favor the Roth version, whether that's Roth IRA or Roth conversions or some version of the Roth with retirement accounts if we actually do want to pay the tax on the money this year. So the longer that we have to spread that out, the more the greater chance that we have of getting that income that you have to pay tax on all of your income at some point, and the greater chance that we then have of taxing that income at a lower number.
%100%. So we were really hoping to leave the last 15 minutes. Feel like we got close. So we're trying to leave the last 15 minutes for any specific questions, anything that you listeners wanted to dig into a little bit deeper. So we'll give a second to kind of open it up for question and answer.
I have just got one question in so far, so if anyone else has any, feel free to put them in, but we'll get started on this one. As we think through retaining employees and kind of how that can set you apart as an employer, especially, when you're going up against larger businesses that your employees could work at. Are there ways, when you're investing towards your employees, does that have to go towards the employees' retirement accounts? Or, can some of those just be gift contributions? Can you speak a little bit to that?
Sure. I guess I'll take that one. But I would say if it's for employees, of course, you could just bonus your employees and it's going to flow through to, their W-2, just like their base wages would. And, of course, you have those retirement accounts, you have other benefits, that may be important to that person. We always recommend, getting kind of a feel. Sometimes employers will have us talk to the employees to try to, kind of just do some reconnaissance and figure out what they may be most interested in. But if we're talking about those non-qualified benefit plans, the nice thing with those is they're not retirement accounts at all. So they don't have those restrictions of, I have to be 60 years old to take the money out. When I take it out, I have to pay tax on it. We can design the plans where I can take the money out and it's tax-free, and we can design those benefit plans where you get to control when it's their money, but otherwise the money is available anytime. So if you said, I gave that 3-year example, if you said the money is your money after 3 years, then you put the money in for them, and then they could pull it out as soon as that year 3 clock has, ticked away, then it's theirs, and if they leave before that, then it's still yours. So you can take all that money back and the growth that was in there in the meantime. So as far as it goes for if the money being contributed to the employees is going to be invested in some way, that would be kind of one, you have the qualified plan side, 401k type of deal, and then you have the non-qualified, which is where you can control the time period and it's not in a retirement account.
Yeah, I'll jump in too. I'll mimic what Ian said, but when we are talking about employee benefits, it is very common for us to come in and do some, conversations with employees to find out, like, an employee benefit only helps if it's the benefit your employees want. So there's a lot of times we've implemented tools only to find out that those weren't the actual tools that anyone was going to be excited about. Well, that's just money spent. So the most important piece of this is determining, if you're using it for retention, the non-qualified that Ian's talking about is great because it puts a timeline. It keeps the money as yours until they've hit a certain threshold. But if we're looking for that benefit package, it's really getting a good understanding of what your team would be motivated and excited by, and then figuring out how we can structure that for a win-win.
That's awesome to hear how customizable it can be and really just work for each operation differently. Great. Well, I am not seeing any other questions, so we've got a few kind of housekeeping things to wrap up today. So if you do still have a question, feel free to drop it. We can pop back over to those. But as we wrap up, I just want to give a big thank you to our friends at Kirby Wealth Management for sharing their expertise with all of us. Were there any parting thoughts that any of you had before I lead off with some housekeeping?
No,
Thank you.
go ahead,
Brian.
Go ahead, Gary. Sorry. Knew that was going to happen.
I know. Oh, well, I don't have my camera on either, so it makes it harder. But no, I was just going to say, thank you, Caitlin and team. We are excited to be here today. We appreciate the opportunity to be sharing, and wanted to let people know that every conversation we have with our farm clients is different. So there's times when there's an existing financial strategy in place, and these tools that we're talking about would be an added benefit or an added piece to an already really nice puzzle. And there's times when there is no plan, you're not sure where to start. Estate planning needs to happen. Financial advisors, accountants, the players you should have at the table, but you don't know how to get them together. And we really help clients kind of navigate and build that full financial strategy. So our contact information is on this page. If there's any way that we can help, or if you're not sure if we can help and you just want to have a quick conversation to see, we're excited for those conversations.
Yeah, and so I'll just echo what Carrie said from the thanks standpoint and just elaborate on, this is full scope planning from the standpoint of we'll work with your accountant, your CPA, your attorneys. We can work with all those different people because they're all part of your financial plan. And we've been down the road a couple of times on this stuff, so we're happy to help. So if there's anything that we can do, keep us in mind, and even if it's just as a resource. But thank you again, Farm Credit, for having us in.
Absolutely. Again, we just thank you for being with us today. Your expertise is so valuable, and I'm sure there will be follow-up questions as we kind of go throughout this. And just knowing that, since this will be recorded, I'm sure there will be people that reach out afterwards as well. Our hope is that each of you listening with us leave with a few useful takeaways or food for thought as you look towards your farm's financial future. A few final items today. The webinar is recorded and will be available by the end of the week along with a link to their slides. The recording can be found on our webpage at farmcreditil.com/minded. When you close out of the webinar today, a brief 3-question survey will pop up. If you could take a few moments to complete that, it helps us improve the experience and ensures that we're bringing value to you in future webinars and topics that you want to hear about. Lastly, check out the webinar that we have available. If you could pop to the next slide. Coming up August 13th, we've got another Ag Minded Hour webinar in our series with Megan Miller from PCM. She will be talking about how to best maximize your opportunities in the carbon market and really get the most out of those dollars that you can receive on each acre. So you can also find additional programs and a link to register at the same web address that you signed up for this webinar at, farmcreditil.com/learning. So thanks again for spending your lunch hour with us today, and a big thanks to Brian, Carrie, and Ian for sharing their expertise.